Okay, so then moving on to after you've got that money, you've raised some money, the company bank account's probably showing more zeros in it than you've ever seen in your life. So then what? This is where you actually start incurring business expenses. And business expenses are the cost of carrying out your business. So things like paying employees, paying rent for an office, hosting costs, acquiring customers, that kind of thing. And business expenses are important because they get deducted on the company's tax return to offset any revenues that are made to lower the taxes that the company pays. And on the flip side, if it's a non-business expense that the company incurs, then that is not deductible on the tax return, so that can increase the profits that the company then have to pay tax on. So again, this is a separation issue. The company will have its own bank account, and that's where the company's expenses should be paid out of. Again, thinking about this from a large company, if you were working at Google, you would not use a Google credit card to buy a toothbrush and toothpaste. So the other thing to remember is that, the investors gave you this money. They trusted you with all these huge amounts of money, and they want you to use that money to make the company a success. It's not your money for you to spend how you please. And believe me, we've had some horror stories of founders who take that approach. We had one founder that we knew of who took investor money and went off to Vegas. And boy, by his Facebook photos, did he have a good time. Needless to say, he's no longer with the company. But really, this is stealing from the investors. Think about it. The concept of business expenses can get a little bit blurry, especially in the early days when you're working in your apartment and you're working 24 hours a day. But the way to think about it is, if an investor asked me what I'd spent their money on, and I had to give a line-by-line breakdown of that, would I be embarrassed about telling them what any of those lines were? And if you were, it's probably not a business expense. So the other thing to bear in mind is that, you're busy running your company at 90 miles an hour, just constant. So you don't have to necessarily think about the bookkeeping and accounting at that point, but it's really crucial that you do keep the receipts so that when you do engage a bookkeeper or a CPA to prepare your tax returns, they can unpick all of this and they can figure out what are business expenses and what aren't business expenses. But they're going to need your help as a founder because they aren't going to know what all these things are. So there is some involvement from you, and the way to make the involvement the least amount possible is to keep those documents in a safe place so that you can refer back to them. So if nothing else that you remember, do not go to Vegas on investors' money and spend that money wisely.
Okay, so in this section we're going to talk about just doing business, and we're going to hit a couple of topics in this section. So the first one is founder employment. Why are we talking about founder employment? Because, as we said a couple times already, the company is a separate legal entity. It exists completely separate and apart from you as founders. And so no matter how prestigious we in the Valley think the title founder is, you're really just a company employee. And founders have to be paid. Working for free is against the law, and founders should not let their company take on this liability. You wouldn't work for free anywhere else, so why is your startup an exception? And companies have to pay payroll taxes. We had a YC company that completely blew off their payroll taxes for 3 years. It was a huge, expensive disaster, and in extreme cases, people can actually go to jail for that. Fortunately, not in this case, but it's bad. So the moral of this story is, set up a payroll service. This is something that is worth spending your money on. But, and I actually think, I'm sure some of the other lecturers have touched on this point, and actually Kirsty just mentioned it too. Don't go overboard on lavish salaries. Minimum wage. This is still a startup, and you have to run lean. So now I'm going to mention founder breakups. And first, what is a founder breakup? In this context, I'm talking about one founder on the team being asked to leave the company, which, because I've just said founders are employees, that means your co-founders are firing you. So why are we talking about breakups in the context of founder compensation? And it's because at YC we have seen a ton of founder breakups, and we know that the breakups get extra ugly when the founders haven't paid themselves. Why? How does it get ugly? Unpaid wages become leverage for the fired founder to get something he or she wants from the company, and typically that is vesting acceleration. So the fired founder says, hey, my lawyer says you broke the law by not paying me. But if you pay me and you give me some shares that I'm actually not really entitled to, I'll sign a release and make all this ugliness go away. And if you're the remaining co-founders, you're probably like, sounds like a good deal. And so now you have a disgruntled person who owns a piece of your company, and even worse, in a sense, the remaining founders are kind of working for that ex-founder, right? Because they're building all the value in the company, and the ex-founder who got fired is just sitting there with their shares going, that's right, make it valuable. So what's the takeaway here? Avoid problems by paying yourself, paying your payroll taxes, and thinking of your co-founders' wages like a marital prenup.
And as well as the founders, you are going to need to hire employees. And again, a lot's been spoken in previous classes here about how to find those people, what makes a good fit, how to make them really productive employees. But when you actually find somebody, how do you hire them? You know, what's involved? And employment is governed by a huge raft of laws, and therefore it's important to get this right. It's, again, the kind of nitty-gritty stuff that as long as you know the basics, you can probably keep yourself out of most situations, but as soon as things get complicated, you need to get yourself involved with a specialist. So the first thing you need to do is figure out if the employee or if the person is really an employee or a contractor. And there are subtle differences to this classification. And this is important to get right because the IRS takes a big interest in this. And if they think you've got it wrong, they will come after you with fines. Both an employee and a contractor will sign documents that assign any IP that they create to the company, and that's obviously really important. But the form of the document is very different for each type of person, and the method of payment's very different. So generally, a contractor will be able to set their own work hours, they'll be able to set their own location, they will be given a project where there is an end result, but how they actually get to that and the means they use will not be set. They'll be using their own equipment, and they'll not really have any say in the day-to-day running of the company or their strategy going forward. And a contractor will sign a consulting agreement. And then when the company pays them, the company doesn't withhold any taxes on their behalf. That's on the responsibility of the individual. But at the end of the year, the company will provide what's called a Form 1099 to the individual and also a copy to the IRS, which they'll use to prepare their personal tax returns. The opposite side of this is an employee. And an employee will also sign some form of IP assignment agreement. But when the company pays them, the company will withhold taxes from their salary. And then the company is responsible for paying those taxes over to the relevant state and federal authorities. And at the end of the year, the employee receives a W-2 form, which will then get used to prepare their personal tax returns. So, as Carolyn has said, that founders need to be paid, so do employees. It isn't enough to just say, well, I'm paying them in stock, so that can be their compensation. And they need to be paid at least minimum wage. So, in San Francisco, which actually has a slightly higher minimum wage than California as a whole, that works out about $2,000 a month. So, you know, it's not a huge amount, but it can add up. There's also another couple of things that you need to make sure that you have if you have employees. So the first thing is that you're required to have workers' compensation insurance. And especially if you're in New York, where the New York authorities that look after this will send really threatening letters saying you owe $50,000 in fine because your one employee that's being paid minimum wage has not paid the $20 a month of workers' compensation fees. So it is really important that you do set that up. And the other thing that's very important is that you do need to see proof that the employee is authorized to work in the US. You know, founders are not payroll experts, and nobody expects you to be one either. This is all just about the basics. But what that does mean is that you absolutely must use a payroll service provider who will be able to look after this for you. And services like Zen Payroll are again set up, they're focused on startups, and they help you get this set up in the easiest way possible, so that again you can go back and concentrate on what you do best. And in the example that Carolyn gave just a few minutes ago, if that company had actually set themselves up with a payroll service provider, all of that heartache would have gone away, because it would all have just been looked after for them. They were trying to save money by not doing it, and look where it got them. So that's really the key thing. Use a payroll service provider and make sure that you understand the basics of employment.
We're running short on time. Yeah. Okay, so I can breeze through really fast firing employees slide, and then should we cut it off now for questions? What?
Why don't we do firing real fast?
Okay, so somebody at YC once said, you're not a real founder until you've had to fire somebody. Why is that? Because firing people is really hard. It's hard for a lot of reasons, including because founders tend to hire their friends, they tend to hire former coworkers, or they just get really close to their employees because working at a startup is really intense. But in every company, there's going to be an employee who doesn't work out, and firing this employee makes a founder a real professional, because he or she has to do what is right for the company instead of what is easy. So I have some best practices for how to fire someone. Number one, fire quickly. Don't let a bad employee linger. It's so easy to put off a difficult conversation, but there is only downside to procrastination. If a toxic employee stays around too long, good employees may quit. And if the employee is actually screwing up the job, you may lose business or users. Number two, communicate effectively. Don't rationalize, don't make excuses, don't equivocate about why you're firing the employee. Make clear, direct statements. Don't apologize. Example, we're letting you go. Not, I'm so sorry, sales didn't take off this quarter, blah, blah, blah. Fire the employee face-to-face, and ideally with a third party present. Number three, pay all wages and accrued vacation immediately. This is a legal requirement. We don't debate or negotiate this. Number four, cut off access to digital systems. Once an employee is out the door, cut off physical and digital access. Control information in the cloud, change passwords, etc. We had a situation at YC where one founder had access to the company's GitHub account and held the password hostage when his co-founders tried to fire him. And number five, if the terminated employee has any unvested shares, the company should repurchase them right away. So the takeaway here is that, as surprising as this may sound, one of the hallmarks of a really effective startup founder is how well he or she handles employee terminations. Okay, so then we had this section that we called legitimacy, which actually goes into a little bit more about how to be a real company, how to be sort of a grown-up company, and we can totally jettison.
Is this the last slide?
No.
That could be the last slide.
We have our
That could be the
takeaways.
last slide.
Okay. So, Kirsty, you want to read the takeaways?
Okay, so we've pretty much covered all of these anyway. But the basic tenet to all of this is keep it simple, do all the standard stuff, and keep it organized. Make sure you know what you're doing. Equity ownership is really important, so make sure that you're thinking about the future rather than the 3 months of the history of the company. And stock doesn't buy itself, so again, make sure you do the paperwork for that. Make sure that you actually know about the financing documents that you're signing up to. It's not enough to just say, yeah, I'll take your 100K. Make sure you actually know those rights. And you need to get paid. You and the employees need to be paid. And then everybody needs to assign IP to the company, because if the company does not own that IP, there is no value in the company. If an employee must be fired, then as Carolyn was saying, do it quickly and professionally. The couple of things that we didn't mention was knowing your key metrics at any time. You should know the cash position, you should know your burn rate, you should know when that cash is going to run out. so that you can talk to your investors about that. And, you know, a lot of running a company is following the rules and taking it seriously. It's not all the glamorous bits that we see in all the movies and TV shows, so you do have to take that seriously.
Okay, so it was shorter when we did it the first time. Sorry about that. Sorry.
You can get like 2 questions in there.
Sure.
Yeah.
How do you advise searching for an accountant, and when in the process do you need them?
So there's two. So the question was, how do you advise searching for an accountant, and when do you, at what point do you do this? So there's 2 different things. There's a bookkeeper and there's a CPA, an accountant. And generally, bookkeepers will be the ones who can categorize all your expenses, and CPAs are the ones that will prepare your tax returns. In the very, very early days, it's probably fine for the founders to just be able to see the bank statements and to be able to see those expenses coming out. But tax returns have to be prepared annually. And so at some point in that first year of the company's life, some service is going to need to be engaged to do that, because it's just not worth the founder's time to do it. There are services available like Indeniro, which kind of try to make things as effortless as possible from the founder's point of view. So that kind of thing is quite useful. But you do need to get a CPA at some point, because you need to file your annual tax returns for the company.
Or how do you find one?
Finding one is kind of tough. Probably the best thing is recommendations from people. With any kind of specialist, a CPA or a lawyer or anything like that, it's always best to use people who are used to dealing with startups. Again, not your sort of, you know, your aunt who lives in Minnesota and doesn't actually know how startups work. So probably recommendations are the best way.
All things considered, what should be my budget for, you know, incorporating with a lawyer, for getting legal advice for my first seed round, and then for hiring the first employees? What money should I set aside for that?
So in terms of incorporation, don't spend a dime on that. You can do that online. Well, actually, I'm sorry. It does cost a little bit.
Yes.
Incorporating online using a service like Clerky, which Kirsty mentioned, is inexpensive, like in the hundreds, not in the thousands. So you don't need a lawyer for that part. When you actually need to hire a lawyer it kind of depends on what business you are starting, and how complicated it is in terms of, you know, do you have a lot of privacy policies? Is HIPAA involved? I mean, you can imagine there's like a ton. And also then you mentioned when you're raising your seed round, well, how much money are you raising? And who are the investors? And what kind of terms are in the term sheet? Sometimes that dictates whether or not you need to get legal counsel.
And again, a service like Clerky can help if you are just using very standard documents for the fundraising. There are just very basic vanilla fundraising documents, so you can use those. And again, they cost, you know, less than $100, I think, which can save you some legal fees.
One more question.
Do you want to pick?
Should we go back over this side? I'm going to ignore Publa. Let's go up here.
Do you guys have any advice or comment on the complexity that comes with working with cryptocurrencies or crypto equities in particular? Like if you're fundraising, since that's becoming more and more popular?
Oh wow, that's a tough question to end with. Yes, there are some issues. Often banks will struggle to deal with companies that are working in cryptocurrencies because they haven't quite figured out how to deal with it and that sort of thing yet. Generally, a lot of it's very product specific. It's not something that kind of has real general advice, unfortunately.
Okay, thank you very much.
You're welcome.